In this video, we're going to talk about chart patterns. Let's take a closer look at what we're going to cover. We'll start by talking about chart patterns and what they are. We'll then move on to look at continuation patterns and reversal patterns. Both these patterns are great for telling us which way the markets are going to go. Continuation patterns give us a high probability that the market is going to continue with the trend, and reversal patterns give us a high probability that the market is going to reverse. So both these tools can be useful when trying to identify potential trade entries. Let's start by looking at what are chart patterns. There are several patterns that are formed on price charts that lead to predictable moves in the market. When you see these patterns develop, you will have a better idea which way the market will break out, and you can take advantage. We're going to take a look at 4 different continuation patterns. Remember, continuation patterns are trend-following patterns. That means we are trying to stay with the trend. The first pattern we are going to look at is the symmetrical triangle or the pennant. We'll then look at the ascending and descending triangles. We'll look at flags, and we'll also take a look at rectangles. Reversal patterns tell us when the market's about to reverse. These can be considered as counter-trend patterns. We're going to take a look at 2 examples, the wedge and the head and shoulders. So let's look at symmetrical triangles and pennants. These patterns occur when price action retracts into a narrower and narrower configuration. Essentially, it's squeezing itself from both the top and the bottom. The symmetrical triangle and the pennant show up just before the market takes off in its original direction. Here we can see some examples of symmetrical triangles. We have a bearish symmetrical triangle and a bullish pennant. With a symmetrical triangle, the market gently eases into the formation, while a pennant comes after a very sharp and quick move by the market. The long, sharp, steep market move in front of the pennant is called the pole. In the first example, you can see a bearish symmetrical triangle. The white line or the white arrow is price. As you can see, price moved downwards, formed a valley, and then moved upwards. It formed a peak, and then started moving downwards again. It formed another valley, and went up, formed another peak. The thing that you'll notice is the valleys and the peaks are becoming narrower and closer together. Eventually, price will break out of the triangle formation. Over 70% of the time, you'll find that price will break out in the original direction of the trend. And in this case, you can see that the price was heading downwards, so it is more than likely that price is going to continue downwards. Next, we can take a look at the bullish pennant. In this example, we can see that price moved upwards, formed a peak, and then fell back downwards and formed a valley. Price tried to move up once more and formed another peak. This time, this peak was lower than the previous peak. Price fell back down again and formed another valley, but this valley was higher than the previous valley. So as you can see, the peaks and valleys are starting to become narrower. And once again, because this is a continuation pattern, there is a 70% chance that price will continue in the original direction of the trend. So in this case, it's a bullish pennant. Price is more than likely to continue in an upward direction. These patterns occur quite frequently on charts, so you can expect to see them quite a bit. Let's take a look at another continuation pattern. The next pattern we'll look at is the ascending and descending triangles. They're similar to symmetrical triangles, but in this case, the leading edge of the triangle is a flat line, or a horizontal line of support or resistance. If you look at the images on the screen, on the left-hand side, we have a descending triangle, and on the right, we have an ascending triangle. On the left, you can see that price had fallen. It hit an area of support and formed a valley. It then moved upwards, formed a peak, and fell back down, hit the same area of support. Price moves upwards and forms a lower peak. Because this is a continuation pattern, price will more than likely break out towards the downside. In fact, more than 70% of the cases, you'll find that in a downtrend, when there's a descending triangle, price is going to break out to the downside. On the right-hand side, we have an example of an ascending triangle. In this case, you can see that price was moving upwards. It hits an area of resistance and falls downwards. It then makes a valley and starts rising up again. But it cannot penetrate the previous area of resistance and it falls back downwards. When it falls down, it then makes a higher valley, and you can see that the lows are getting higher, but price is finding it difficult to break out above the resistance area. When price does eventually break out of the resistance area, we can expect to see it continue in the direction of the original trend, which in this case was bullish. This is a continuation pattern, so price will continue in the original direction of the trend at least 70% of the time. Now let's take a look at a flag. Flags generally start off with a large quick move forming a fairly steep pole. Next comes the flag formation as it gently moves up and down slightly against the initial move. To be a true flag, the formation takes place between two equally separated lines, a small support and resistance channel. Here's an example. Here you can see bearish and bullish flags. The bear flag is formed as a slightly rising formation, while a bull flag is formed as a slightly falling formation. On the bear flag image, you can see that price had been moving downwards. It formed a valley and then reversed. Price then moved upwards and formed a new peak. It fell down again and formed a higher valley. Price rose up once more and formed a higher peak. And as you can see, price has been contained between the upper red and the lower red lines. The upper red line serves as an area of resistance, while the lower red line serves as an area of support. Because this is a continuation pattern, you will find that price will usually break out in the direction of the original trend. And in this particular pattern, a bear flag, price is moving downwards. So in most cases, we can expect price to move to the downside. On the right-hand side, you can see an example of a bull flag. Price had been moving upwards. It formed a peak. It started a zigzag and pulled back. It formed a valley. Price rises up again and forms a lower peak. Price then falls again and forms a lower valley. Price will normally continue to move between the upper red line and the lower red line. The upper red line serves as an area of resistance, while the lower red line serves as an area of support. Again, because this is a continuation pattern, you will usually find that price will break out in the original direction of the trend. In this particular case, with a bullish flag, price was moving in an upward direction, and when price breaks out, you can normally expect it to break out towards the upside. Next, we can take a look at bearish and bullish rectangles. These occur when the market is considered to be in a range. As price slows down after a bigger move, it will want to drift sideways for a bit. These rectangles are basically price moving up and down as regular business in the world influences the price, but it's pretty stable. As you can see, on the left-hand side, we have a bearish rectangle. Price falls and hits a support area, rises up, forms a peak, and as it zigzags between this range, it forms an area of resistance and support. Eventually, we're going to expect to see price break out of this range. Because this is a continuation pattern, in most cases, you'll find that price will range and then break out in the original direction of the trend. You can see the same thing on the bull rectangle. Price moves upwards, it hits an area of resistance and bounces off. It then goes on to form a valley before rising upwards and hitting the same resistance area again. Once again, price reacts in this area, falls downwards, and is trapped within the range. Price will continue to bounce between this range, and because this is a continuation pattern, we can usually expect to see price break out in the original direction of the trend. In this case, that would be an uptrend. Rectangles are price action that you can sandwich between two horizontal lines, or support and resistance levels. You'll find this after a big move, and also after the major market participants go to sleep on a smaller time frame. A pause in the market that has a clearly defined high and low. It can be very narrow, as in a consolidated market, or a little wider, where there is actual price movement inside of it. This is a classic formation for a breakout type of trade. Traders that like to trade breakouts typically look for rectangle patterns. Now let's take a look at some reversal patterns. We'll start with the wedge. The wedge happens almost every time a decent reversal is about to happen. For a bullish wedge, price must be trending lower. At the bottom of the trend, the last couple of lows are very shallow, almost a kind of bottoming out. The first low is followed by a slightly lower low. The highs, however, are not as shallow. They keep falling more dramatically than the lows. Let's take a look at an example. Here you can see bearish and bullish wedges. You'll notice that a topping out of prices, price narrows, followed by the reversal. On the left, you can see the bearish wedge. As price is moving upwards, it starts to slow down and starts to zigzag. The valleys are getting significantly higher, but the peaks are not getting much higher. They are moving in an upward direction and they are higher than the previous peaks, but eventually price will break out, and in this case, because it is a reversal pattern, you can usually expect price to fall or at least move in the opposite direction. On the right hand side, you can see the bullish wedge. Price was originally moving downwards. It goes on to form a series of valleys and peaks, and these valleys and peaks tend to get narrower. The valleys are getting lower, but not by much, and the peaks are still moving dramatically lower. The price action starts to narrow and you can expect to see a breakout. And because this is a reversal pattern, you can usually expect to see price move in the opposite direction. In this case, because it is a bullish wedge, price had originally been moving downwards. So this would be a good place to look for buy trades. Let's take a look at another reversal pattern. Let's look at the head and shoulders. This is probably the single most popular chart pattern out there. There are actually traders that look for this formation almost exclusively, and they do pretty well trading it. It is made up of a high, being the left shoulder, followed by a higher high, making the head, and finally, there is another high that is lower than the head, forming the right shoulder. Let's take a look at an image. Here you can see the classic head and shoulders. It consists of a high being the left shoulder, and it is followed by a higher high, making the head. Finally, on the right hand side, there is another high that is lower than the head, forming the right shoulder. The best opportunities to enter a trade can be found when price breaks out below the neckline. So where does the neckline come from? The neckline is formed by a trend line drawn across the lows. The head and shoulders pattern is a bearish pattern, and it starts out with a higher high and a higher low. What follows is a lower high. This interrupts the pattern of an uptrend and is the beginning of a downtrend. The head and shoulders pattern assumes that the beginning of a new trend direction will have some follow-through. Let's take a look at the inverted head and shoulders. This is the bullish version of the pattern, and it is called the inverted head and shoulders. On the left-hand side, you can see the head and shoulders, and on the right-hand side, you can see the opposite, the inverted head and shoulders. The inverted head and shoulders is basically the opposite of the head and shoulders pattern. As you can see, with the inverted head and shoulders, price had fallen and formed a valley. It then rose up and formed a peak, and then fell once more and formed a lower valley. Next, price rises and forms a lower peak. This peak is lower than the previous peak. If you drew a trend line across these two peaks, this would form the neckline. Price then goes downwards and forms a new valley that is higher than the previous valley. This forms the right shoulder. The next move that we can expect is for price to break out towards the upside, and in this case, we can look to enter the market with a buy trade. So that brings us to the end of the chart patterns video. Thank you for watching. I'll see you in the next one.